Hi guys, Brie and Glen here from the Loan Room. We've had a lot of questions lately about early investors, so we thought we'd jump on here, have a quick chat and try and answer some of those for you. So I'm going to throw to Glen and he's going to tell us how we can access a deposit as an early investor.
Yeah, beautiful question, Brie. So a couple of different options that people have got. And I guess firstly, the one that comes to mind initially is that if clients have actually got some savings that they've tucked away in an offset account that have been parked away, or the second option is to access equity from your home. So someone may have purchased a property 5-10 years ago. Over the course of making those repayments, they've built up a fair bit of equity. So there are two ways in which people can use a deposit. The first one, in terms of using your savings, is probably not going to be your best option from a tax deductibility. So without going into tax advice, and always double check with your accountant, but if you were to use your savings, that doesn't necessarily form any tax deductibility. So when it comes to tax time, the other option is perhaps going to be the best option for you, and that will be to draw down on the equity in your property so that that loan, when it gets set up, is a separate loan, and therefore then when the accountant comes to look at your finances, that loan is a tax deductible loan.
Yeah, great. And so how do we actually access that equity? What's the process and the loan? So you mentioned having two loans there.
Yep.
What does that actually look like through that refinance process?
Absolutely. So it generally involves a refinance. So what we would do is we would look at your circumstances. Obviously, the first point of call is to make sure that you are on the very best loan for your owner-occupied, so that you're getting the best rate and matching it to the features that you need. And also we need to consider the deposit loan for your investment property. So again, going to a lender that's going to facilitate pulling cash out, where some are a little bit restrictive with how much you can pull out. So it's essentially setting up a separate loan. You've got your owner-occupied loan that you'll pay down, and then the second loan as your deposit for your investment property.
New one, yeah, sure.
Yep.
We also get a lot of questions around cross-securitizing properties.
Yep.
Do you want to maybe explain the pros and more so maybe the cons of that?
Yeah.
And what you're looking at if you do go down that path?
Yeah, absolutely. So cross-securitization is simply where the banks take multiple securities to secure a loan. So in the example that we've talked about, instead of refinancing and creating two separate loans, what you would do is borrow the full purchase price of your new investment purchase and use your existing owner-occupied property as additional security. So I guess the advantages are that it's a little bit clearer in terms of that you've only got one loan against your new investment property, but certainly the cons are that the owner-occupied property is linked to your investment property. So if you were to do anything that changed your financial circumstances in the future, both properties, I guess, are at risk or jeopardy. So in terms of paying loans down, there's ramifications in that side of things. By keeping them separate, you're doing just that. You're keeping things nice and separate, clean. What it does is that it opens you up to going to a separate lender for your investment purchase, who may be a better option than the existing lender for your owner-occupier. So having separate loans is sometimes a benefit there.
Yep, definitely. And does it change at all taking equity out of an owner-occupied home versus taking one out of an investment property? I guess people get a bit confused. There's a difference, as you mentioned, tax benefits across each one.
Yep.
Does it change taking equity out of each one?
No, it doesn't. Essentially, you're taking equity from a property. The new loan that you are going for is an investment loan. So from the bank's point of view, the pricing is based on the purpose. So whether or not you're taking equity out of an owner-occupied or out of your investment property, the pricing is based on the purpose. It will be an investment deposit, so that little extra loan will be an investment purpose.
Which brings me to my next question. How does the interest rate change when you are purchasing for the purpose of an investment?
Yep.
Is it a higher risk, and how does that look for our borrowers?
Yeah, so lenders at the moment have got different pricing across different purposes, so owner-occupied versus an investment. They also have different pricing, principal and interest versus interest only. So depending on the bank's appetite, depending on their structure for risk, it does change. From the bank's point of view, it's just basically the purpose that changes. So if we're going to an investment, that's what the pricing is based on. And depending on your structure, if you want interest only repayments, it's priced based on that. If you're wanting to reduce the debt, it's priced on the principal and interest repayments.
Sure. And when we're accessing equity, obviously our LVR change, that's loan to value ratio. So we want to just clarify how that looks once we've accessed the equity and up to what amount we can reach to.
Yeah, correct. So if you are taking out equity for your new deposit, absolutely the loan to value ratio is going to increase. You're borrowing more money as opposed to the value of your property. So that will go up. Banks will allow you to take it up to 80% without the lender's mortgage insurance. So yeah, allows you to go up to that 80% mark. As long as you've got the equity, then you can do that for sure.
What would be your number one tip for our early investors out there?
It's a great question. I've probably got 2 tips for people to consider. One of them is definitely engage with some specialists. So you've really got to make sure that you speak to your broker. Reach out to us here at the Loan Room. We've done this plenty of times for clients and we know exactly the best way to structure things up for your circumstances. And the second one is probably don't delay. Get in
Correct.
and do it. Jump in, have a chat with us. You are probably going to be ready, even though you may not feel like you are.
Yep.
And even if you aren't quite there, then we can certainly put you on the right track. So reach out to us, as soon as you feel that you need to, and we'd love to assist you.
Thanks guys, that's all we've got today. If you have questions, send them in. This was super easy to have a quick chat and hopefully it's answered all your questions.